Hello everyone. The RBI Monetary Policy Committee decided to vote in favor of a 35 basis rate cut in the benchmark repo rate. Now yes, it is 35, which means it's a departure from the conventional 25 basis and multiples of 25 in terms of the rate actions that we have seen historically from the Reserve Bank of India. Now this in some sense has significance and yet may not be too very significant from a market standpoint. Why is it significant? Because it suggests that they are willing to think non-conventional, number one. From an immediate relevance perspective in terms of market impact, it did not really have a material difference because the bond markets were already pricing in a 25 basis cut in repo rate, and 35 basis point cut meant that the incremental delta was just 10 basis points, which is why from a bond yield perspective, the 10-year benchmark sovereign bond yield, which was trading at about 6.33%, post policy is trading at about 6.4%. Not a material jump in yields, a small disappointment, but we think that is manageable. What is critical to note in the policy stance is A, the accommodation bias continues, B, incremental rate cuts or rate action. Of course, in this case, it is rate cuts because we are in the accommodation mode as yet. The incremental rate actions would be data dependent, and last but not the least, there is every intent to maintain comfortable liquidity in the banking system. So if you blend all that put together, I think the policy statement or the stance seems to be recognizing that global growth is sluggish. Global headwinds on growth will at a point in time percolate into India growth potential also, and hence it is not time to overtly worry about inflation at the current juncture. Which is why in the policy statement we have seen a small downward revision on both counts, both the GDP growth estimates as also the CPI or the retail inflation in India. What is the view going forward? We believe that the rate cut cycle is not fully over. Quantum, of course, now it could be ranging from 10 basis points to 50 basis points in terms of incremental tranches to come. The good news is that so far we have seen 110 basis points or 1.1% of rate cut already. It is imperative to see the percolation of this rate cut as transmission into the real sector, which is what we expect in the coming weeks and coming months. But as I said, there is a high chance that this rate easing cycle has not yet stopped, which means there is still light at the end of the tunnel as far as the bond yield curve is concerned. We believe that 6.4 to 6.5 being the higher end where markets will tend to consolidate, the next leg move for the bond yields would be on its way downward. This applies for across the curve, but the predominant sweet spot to our mind, which gets the best of both worlds, A, comfortable liquidity, and B, softening in yields, is largely the 1 to 3 year bond segment, predominantly in the corporate bonds. One line in terms of credit, we believe that the extreme paranoia as far as the credit outlook is concerned seems quite exaggerated. While there will be some small distortions still coming along, bulk of the pain points seem to be behind us. We expect the corporate bond yields to stabilize at the current levels, and once the markets get clarity on how the next tranching of the credit cycle will flow, we could actually start seeing compression in credit spreads, but with a lag of maybe a quarter or two. What then should the investor focus on in this kind of a market scenario? It looks like with incremental downward pressure on the benchmark rates, strategies like liquid fund will probably mirror the repo rate or the benchmark rates as these strategies may not want to extend maturity profiles beyond 30 to 40 days. It is therefore imperative for investors such as you to actually elongate your maturity profile when you are making allocations to fixed income fund. So a combination of non-liquid strategies clustered around the short-term bucket with a top-up of strategies like the dynamic bond fund and the credit risk fund with an investment horizon of at least 3 years is the recommended way forward given the current macro situation. We continue to watch the incremental data points, most of them which are suggesting a slightly benign interest rate journey going forward, and we believe that there are fixed income solutions to benefit from this kind of a macroeconomic situation. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.